Okay, ladies and gentlemen, so in this workshop, we're going to be going over three main things that you can. It's like I'm telling you, this midnight snap indicator can be very, very powerful if you respect it. If you really take the time to dive deep into everything you can do with this, it can be pretty powerful. And so we're going to be going over 15-minute segments. Okay, so this little 15-minute, what does all these boxes mean and how to use them to your advantage. We're going to be going over how to actually get the hourly statistics, because a lot of people ask me, well, how do I see every single opening price hour, and not putting it on my chart. And then the RTH conditions. Okay, so how do I use the RTH gaps and the RTH gap data that you guys see here? And how do I really use it to kind of gauge my risk, tailor my risk, and get it to where every single day my risk is derived from the probability conditions that the data says? And so before I get into this, please understand, I'm not a financial advisor. I'm not licensed to give you trading advice. I'm not licensed to do anything. I'm just a dude on the internet that respects data. Okay. And so I love talking about it and I love showcasing what I do, but I'm not telling you should do any of this. So the first thing that we're going to be going over is the 15-minute segments. Okay. So the one really, really, really cool thing that I love to showcase with this is the basic midnight retracement. Okay. Now, again, in this opening hour, I know this is called midnight snap, but you can put any opening price you want. You can put the 7 o'clock, the 5, the 3, the 2. You can go all the way down to the minute. You can do the 8:15 opening price, the 7:30 opening price. But for now, we're just going to keep it simple and say open hour is 0, minute is 0, and we're just going to be going over this little box on the bottom left. So what this is going to show you is if I go to the hourly time frame and I just want to build data, because one thing that a lot of people kind of misconstrue with this indicator is they think it's like a prediction tool or something like that. This is not predicting what the market is about to do, okay? I know there's some indicators out there that I think it's like called candlestick predictor or something like that, where there's indicators out there that trying to show you a prediction of what's going to happen. This is not doing this. So what I tell people is you can keep this on your chart if it just helps you to kind of see the heartbeat of the market. But when you're doing your initial analysis, or at least even your daily analysis, like when right before you start trading, you don't need this on your screen. All you need to do is say, okay, we got a 68.7% in the past 953 days. If I drop down to the 1 minute, this allows me to see the past 15 days has been an 80%. And again, you're going from time frame to time frame, and this is only pulling how many candles you have on that chart. So a lot of people, they'll be on the 1 minute time frame and be like, how do I get 900 days? You got to go to the hourly. Why? Because you get more candles. Each candle represents 1 hour of time, but you have the same amount of candles per chart. And so on the hourly, you can go back 900 plus days. On the 1 minute, you can only go back 15 days, and this also depends on your TradingView subscription. But no matter what subscription plan you have, you can still see the relevance of, in the past 15 days, we've retraced midnight 80% of the time. So 15 of those, right? 80% of that. And then on the 1 hour, you can see 68.7 in the past 953 to be exact. Now, what you can do to do an in-depth data pool, it's very, very simple. You can scroll all the way back to the beginning of your chart. And again, this is going to be dependent on your TradingView plan. And if you want to say, you know what, I want to pull 10 plus years like Austin's talking about, what the heck is this dude talking about? So when you're on the continuous NASDAQ contract, the NQ, MNQ, whatever, you're not going to be able to go back on the forward part of the chart and then get a new fresh set of data. But what you can do is if you type in NAS and you pull up the CFD version of NAS, right? So let's just use a Wanda NAS 100 CFD. It's the same thing. It is the same thing, okay? It produces the same candles. Yes, the prices and the movements are going to be very subtly off. The data is going to be the same, okay? It does not matter what chart you pull this from. It's going to be the same. But when you're on the CFD version, when the indicator loads here, you're going to be able to see that I can go back to the start of this chart. If the indicator won't crash on me, it may crash. We'll see. it's loading. We'll see. But when you go to the main start, you're going to get a fresh set of 950 plus days, right? And so you can take that. See, it's going to crash. I'm not. In order just to save time, I'm going to show you guys. When you go to the start, you can then take the averages of all of how many ever data pulls you do. So if I only do this twice, right, and on this current chart, let's say it was giving me a 68.7% from 953 days, and I click replay mode, look at this. Now I get a whole new set of 950 plus days. And now, if Midnight Snap would load, again, every time I record, it never fails. If I do a live stream, it always wants to do whatever. But there will be a table here, and it will show you, like, hey, okay, in this 950 days, it was 65%. And so you would just take the average. If the first set of 900 was 68.7, and then this set was 65, average is around 66, 67%, right? And this is what I mean when I say you can pull 10 plus years of data in a matter of minutes, right? And again, depending on your trading view plan. And so in any part of this data that we pull, you're going to find a very, very, very strong commonality. And that's, if I get out of all this, we go to current market. Let's let the indicator load. There we go. So you can see, no matter how much data you pull, this little 15 segment, these little 15 segments, what they represent is from minute 0 to 14. If I have sessions 8 to 11, let's just say 11. Let's just keep it rounded. From 8 to 11, how many hourly candles, hour chunks of time is that? You have the 8 o'clock hourly candle, the 9 o'clock, the 10, and then the 11. But we're ending on 11, so it's really just 3, right? Because we're not taking into account the entire 11 o'clock candle. We're shutting it off at 11, and so you have one full 8, one full 9, and one full 10. So you have 3 hourly candles in this range that we're measuring, okay? And within those 3 hourly candles, we're able to see down to the 15-minute increment where these retracements are most likely happening. So we're able to see from minute 0 to 14 is the second highest. We can see the largest on the recording here. I'm going to drag this up just a little bit. You can see on the largest span of this data set, out of 953 and out of the 65.5%, the majority of this 65.5% is coming from minute 30 to 44. And so now we know if I'm doing 8 to 11, I know at 8, if I'm looking at this from a statistical standpoint, 8:30 to 8:44, 9:30 to 9:44, and 10:30 to 10:44, those 3 hour segments has the highest probability of this retracement happening. So now let's go down to the 1 minute. Remember what I said. 9:44 or 9:30 to 9:44, 10:30 to 10:44, and 8:30 to 8:44. So these 3 chunks of time is the highest probability. So now let's go and just see what the previous week did. I won't waste too much time here going over this. Look at this. Everybody wants to say this was a news candle. Trading news is crazy. Oh my God, it's so, you shouldn't trade NFP here or CPI this. You shouldn't trade. You only trade when the moon aligns with the stars and Polaris is below the Antarctica, right? Like we can't trade unless everything is perfect. This is why I laugh at that stuff, because it doesn't matter. News or no news, statistics are statistics. And ladies and gentlemen, if you keep treating high impact news like this crazy anomaly, you're gonna drive yourself crazy and probably eventually stop trading, because high impact news is always going to be a common. It is a constant in this market. You can't treat high impact news like a variable. It's always going to be CPI, PPI, NFP once a month. You're going to have FOMC. You're going to have Jerome Powell opening his mouth for random reasons. You're going to have, that's a constant. So you have to learn to thrive in all of this stuff that people want to create artificial problems with. People want to say you're not supposed to trade around this or do that. Just like people are supposed to say you're supposed to have the most perfect risk to reward. All this junk. oh, the market conditions were choppy. You're right, because the markets range more than we trend. And so 78% of the time, they're going to be choppy. You hear all of these common complaints amongst traders. But if you just kind of like step back and realize that the majority of these complaints are just how the market normally moves. So why would I complain and why would I try to say that I'm a victim to the majority of how the market moves? Instead, just learn how to thrive in the majority of how the market moves, right? If the market is choppy, you should be happy. How do I thrive in quote unquote choppy conditions? Because that happens the majority of the time. So look at this. So what did we say? 8:30 to 8:44, 9:30 to 9:44. Look at this. 8:30, right on the dime. Highest probability of retracing to midnight between 8 to 11. Let's go to the next day. Next day was 8:03. What is the second highest? So if this is the first highest, what's the second highest? We have 8 o'clock to 8:14. We have 9 o'clock to 9:14, 10 o'clock to 10:14. Look at that. 8 o'clock, first part of the hour. Let's look at the previous day. And this is not me, cherry picking random. This is the most previous week, right? You can see this everywhere. And that's the cool thing with data is you don't have to believe me. You don't have to say, hey, trust me, bro. This is the best fair value gap to use. Hey, trust me, bro. This is a high probability order block. Hey, trust me, bro. This is the liquidity sweep you want, not this one. You don't have to believe me. You can go and test this for yourself and see the same thing in seconds, just like I do. That's the beauty of trading with data. And so you can see right here, 803, second highest probability. Failed to retrace. Oh, no, we didn't fail to retrace here. Look at that. Guys, you can't make this up. Look at this. We failed to retrace the entire morning, and then within the highest statistical probability. Oh, no, I'm sorry. I thought this was 8. I thought this said 1033. Either way, look at this. Still retraced on a dime because 73% in the past 15 days or in the past 900 plus years, 68% of the time, does not matter the time, still retraced on a dime. 1022. It was the third highest, which is the second lowest, but it's still retraced on a freaking dime. Look at that. Boom. And then took off. Look at one more. 11 o'clock. The last portion, the absolute last minute that price had to retrace in the highest probability time. And it retraced the second highest, which was the top of the hour. And so what these 15-minute segments can show you is just where to know when the move is most likely going to happen. You can gauge your risk off of it. You can tailor your risk off of it. There's so many ways that you can extrapolate this data to build it into your risk. You just have to pick one, right? That's the problem is people want to every single day jump around and do all this crazy nonsense, do backflips and cartwheels on the charts instead of just doing the same thing. And so another great example is power hour. Power hour, we have this really cool phenomenon where we retrace to the 1400 opening price. It's just a very high probability. And so if I go to the hourly, did I put in the settings right? Let's go back to there we go, 56.2%, right? That's pretty good. That's pretty good, especially for a PM session. That's pretty good. And so you can see in just power hour, the highest probability in the past 920 days, the highest time for us in just 1 hour is to retrace to that 1400 opening price. Look at when it is. It's either at the beginning or the end of power hour. How many times have you all seen power hour in that last 30 to 15-ish minutes go absolutely crazy? Now you're able to see why. Now you're able to put statistics behind what you think you are seeing. And if what you are seeing is recency bias or if it's actually something happening. And so now let's just take a look at a time where we retraced to 1400 and you can see the statistics of when that most likely is going to happen. So let's go to this day right here. Okay, so 1500. Look at that. We retraced it in the second highest, and we were literally like 2 points away from retracing. So let's go to another day. All right, let's go to this day. All right, so literally we still haven't retraced it. Remember, the statistic is from 15 to 16, so even though it retraced it here at 1459, does not matter. We care what happens in the session that we're time anchored to, okay? And so we retraced right here at 1522. It's the lower part, but still we retraced it. Go to the next day right here, 1501, retrace the 1400 opening price, highest probability. And so what the 15-minute increment is really cool at doing, especially if you're time anchoring a session in just 1 hour, is you're able to see if you only have 1 hour chunk of time from 15 to 16. Well, at this specific time at 1500 to 1514, that is your second highest probability, which is pretty much tied with the ending, which is 1545 to 1559. So when you do hour chunks of time using Midnight Snap, you can use this 15-minute table to show you that specific hour, what that specific hour is most likely going to do for price. It's really, really cool. So do I have any questions as far as the 15-minute segments go before I move on to the hourly stats? Hourly stats is pretty straightforward, and so is RTH. So this was like the most in-depth that I wanted to go over. So does anybody, we got 81 people in the audience. Anybody have any confusion around how to extrapolate these 15-minute chunks of time with any data set that you put here? Any data set at all. It can be whatever. And you're finding the highest probability price movements in those chunks of time. I'm just a dude disguised as a dude who's playing another dude. Yeah, I'm just a dude, man. I just trade data. I just trade data. That's it. See a couple people typing, so we'll wait. Could you go over the days of the week and its percentage? Yeah. So this days of the week. Okay. So what this days of the week does is it shows you based on. So let's go back to midnight, because this one's very relatable for a lot of people. A lot of people trade from 8 to 11, and midnight is very important for a lot of people, no matter how you trade, like me or whatever. So if I go to the hourly, again, to get a good chunk of data, get about 900 days, and I can see out of the 65.4%, okay, one common mistake is people think that this means, so like on a Friday, this means that Friday is 16.4% probability of retracing. This is not what this means. These percentages are showing you what is the majority contributor to this overall percent. Okay, so if I have 65.4, who is the majority contributing to this high probability here? So we can see 20.29 is Wednesday. So we can see objectively that Wednesday has the highest in the past 943 days, has the highest probability of retracing to midnight. And then the second highest, Thursday, 20.44%. Thursday is the highest. Wednesday is the second highest. Tuesday is the third highest. Monday is the fourth highest, and Friday is the lowest at trading. So you can use this data just right here alone to have tons of reasons to gauge your risk, right? And to know where you're positioned at during the week. For Midnight Snap, don't you have to start at 23? No. So that was the old version. We got the bug fixed. So what 21's talking about is before you had to put 23 here because there was a bug that was messing with future contracts versus CFD contract. It was weird, but just know, no, you don't have to do any weird science now. Just make your time zone, whatever your time zone. Man, listen, guys, just make everything American in New York. All right, don't even worry about trying to sit here and convert what your time is. The world doesn't revolve around you. All right, the market revolves around the EST time frame in London. That's basically it. So speak in New York, speak in EST when it comes to trading, and so that way you don't even have to worry about trying to convert and waste your time and cause a bunch of stress for no reason. So when you set this to American in New York, you can put 0 here. That'll represent midnight and so on and so forth. Do you usually extend the session up to 11:15? Yeah, that's what I use. I use 11:15. I just did it for round numbers to show you the 15-minute increment. But yeah, I use 11:15. Made it clear. Thank you. Absolutely. Cool, cool, cool. Bradkin, I'll do that in another time. We're talking about Midnight Snap right now, so let's keep this on track with Midnight Snap because then we could talk. We'd be going over 20,000 bazillion things, and I want to keep this to about an hour ish. Scott. All right, so let's move on. Okay, so the hourly statistics. So if we understand, guys, and if we can agree, and I really hope we do because this is a proven fact, majority of the market is ranging. Okay, the majority of the time we range more than we trend. Okay, we are not doing this the majority of the time. We are doing this the majority of the time. So when you are saying to yourself, "Oh my God, I'm getting chopped up. Oh my God," it's because it's just how the market moves. Oh man, it looks choppy today. Oh man, we're whipsawing today. All these weird terms that people use, it's because we do it more than we do this. But guess what people do? Is people are trying to be professionals at doing this. And hey, if you can do this and do it consistently and do it quarter over quarter, not just one trade and saying, "Hey Austin, look, I won this one trade." You're wrong. No, if you can do this quarter over quarter, tell me to shut up and just go the other way, right? But majority of the people can't. The majority of the people can't, and it's fine. It's normal because guess what? We're retail traders. Timing the market is practically impossible. You know what I mean? So instead of trying to sit here and be a master of the minority of the move, how can we just say, let's just reduce the stress dramatically and be good at what the majority of price does and what the majority of price gives us? So that's where we go into the opening hour statistics. So if we know, I just deleted my little thing here. So if we know that we do this, okay, more than we do the other part, guess what's happening in this range? There's opening hours being created. So let's say right here's midnight. And then let's say this is 1 a.m. And then let's say this is 2 a.m. And this is 3 a.m. And this is 4 a.m. And this is 5 a.m. And this is 6 a.m. And this is 7 a.m. So if you were to draw out visually every single one of these lines, and they have, let's say, a 70+% probability attached to it, and the only way for these lines to have a 70-80% probability attached to it is for price to come back and retrace to it at a certain point of time, what would you assume that the market does the majority of the time? Range, right? Because if we were trending more than we ranged, we would the statistics would be terrible for these opening prices, right? Because if we're doing this more than this, then if you were to take all of these opening prices and put them here and do the same exercise, these would be terrible. The statistics would be 40%, 30%. And then you, in another dimension, you'd be hearing me talk about how we trend more than we range and how I trade away from these lines instead of to them. And so this is why I tell people it's very simple to see and defeat the argument that we range more than we trend, because you can take Midnight Snap and see it for yourself. That these retracements to these opening prices of whatever is consistently happening more than it's not. And so how you can do that is, let's say right here, let's just choose this random Wednesday, 21st of August. Let's go back to this day, last week. So we already know that midnight is the guiding light, right? Midnight is the anchor. Wherever we are above or below midnight, that is what I am trading towards, hands down. Don't care what you think. Don't care what you say. I'm trading it. Another cool thing that I can do to let me know when to increase risk or keep risk the same, because I'm never filtering a trade. Okay, I need you guys to understand that the quote unquote filter of a trade, it's completely a myth. You can't filter a trade. All you do is you either choose to accept the probability that's about to happen, or you don't take that trade, but now you just have created a new set of probabilities. And what I mean by that is people will want to say, well, if you just add all of these confluences, it filters out bad trades. No, it doesn't. You're just creating a new set of probabilities, because now your new set of probabilities and the way that you're trading now still is going to take loss. You're still going to lose. No strategy is a 100% hit rate. And so how can you gauge your risk and tailor your risk to high probability situations versus the normal setups that you have? So your normal setup should already be high probability. Why would you take a trade that's a low probability? That's crazy. And so really, the only two things in my playbook, I'm not saying what you should do or what you have to do, but for me, it's high probability and SpongeBob foaming at the freaking mouth. All right, these are the only two. These are the only two grade setups I care about. I care about high probability trades, and I care about SpongeBob foaming at the absolute mouth. And somebody in the chat, for people that don't know what I mean, just drop the gift. Okay, we already got it. That's all I care about. Why do I need to sit here and act like this is high school and I'm like, oh, this is a B setup. Why would I take a B setup? Why would I take a C setup? Why would I take an A? It's either my baseline is high probability, or if we're overextended above or below data, I'm foaming at the mouth and taking that position. And so now, how do I see the SpongeBob foaming at the mouth trades? Opening hours. That's a really good one that everyone has access to with Midnight Snap. And so what you can do is, let's say again we're trading from 8 to 11:15, and we already know that the 68.5 is attached to midnight. Let's go to the 1 o'clock. And so what we're going to do is we're just going to filter throughout, not filter, we're going to cycle through every opening price, and we're just going to put a data point attached to it. So you can see right here, the 1 o'clock opening price, it has a 69.8% probability of being hit right here. Now you can go to the next one, the 2 o'clock opening price. While that's loading, you can go find it right here, the 2 o'clock opening price. Boom, put a horizontal ray to it, 68.9, 68.9. You have the 3 o'clock. We're going to do one of these because these do take a little bit of time, and I don't want to sit here and waste everybody's time because you guys get the point. 3 o'clock opening price has a 71.7%. 4 o'clock opening price. And again, people are going to say, well, Austin, if you draw enough lines on your chart, you're going to hit them. You're absolutely right. So freaking do it. If you know that 4, 5, 6, 7 lines have all of these probabilities attached to it, and you're overextended above the majority, what do you think you should be doing, right? Like where do you think your risk should be? Probably should be where there's going to be an overextension of the data, right? When I say data is above or below price, this is what I'm referring to. We're above or below a lot of data points that are statistically relevant, right? 79.7. 6 o'clock. 83.1. Now, again, what do you notice? The closer we get to the 8 o'clock, obviously these data points are going to be higher and higher and higher and higher, because the closer you get to the opening price of every single one of these candles, the less distance that price has to move to get to that, end goal. All right, so now we have probabilities of everything. So now we know, starting at 8 o'clock, this is where the heartbeat of the market is. So let's drop down to the 1 minute. So right here, boom, starting at 8 o'clock. Let's put midnight back on our chart because now we have everything else. So we've just retraced midnight. What do I tell people? We retraced midnight. We successfully completed the edge. The edge has been done. So now I do what's called taking distribution trades. I take 10-point distribution trades towards all of these different data points, right? Like, this is what I do now. So I'm not going to get into my entry process and all that because it's not relevant. I just want you guys to see the data. And so now look, we have 2 data points above and the majority below. You could even make zones out of these. You could say, you know what? Here's the majority. Here's the minority. Let's see what happens. We come up. We take out 69.8 and 86.3%. Now, just looking at data. Okay, nothing else. No other patterns. No, I could even turn the candles off. Right? We joke around about trading with no candles. Well, if the price is here, if we could see that active price, where do you guys? So we got 83 people in here. Just drop in the chat. Are you looking for longs or shorts? Right? Now that you see the data, the objective black and white data in front of you. And now for the people in the recording, everyone is saying short. Big O, Raxith, Raw, Host Trader, Quad Girl, Ariana, Mars, Carl Hungus. Pocket Aces says drop it like it's hot. Scott says longs off the high probability fair value gap because Scott's being Scott. Everyone's saying short. Why is that? Did anybody here that said short have to go and study to apply to become a NASA scientist? Did anybody here have to sit here and say, well, it's this order block combined with this high probability here, and then you got to know the market condition, are we bullish or bearish, and the fundamental analysis of this, and blah 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 blah. No. In 5 seconds, everybody was able to see, oh my God, we have an 83% right. Does this mean that we're going to come and hit all this? No, I actually don't even know what we're going to do. I forgot. I have a short-term memory problem. All right, like, I don't freaking know. But I know that the probabilities are here. I don't care if we rip into oblivion. I'm just not going to participate. But if I get a probability trade to the downside, you best believe I'm trading it. And if I'm overextended like I am here, I'm going to increase my risk because I'm foaming at the mouth. So let's see what price does with nothing else. We come down and collect the 75.4 and 71.7. Right? Because I'm a day trader. From this move right here, from here to here, produced 52.5 points. Right? Do we end up coming back? And we end up even coming lower. And look at that. I mean, look, everyone here was bullish. I remember this day now. I remember this day. Absolutely, I do. Because this was Wednesday, 21st of August. Yeah, right around here. Oh my, everyone was bullish. Everyone was bullish. People were going long. I've seen so many people going long here. I remember this day. But we still had probabilities below. We retraced 75.4 and 71.7, but we still had a 79.7% probability here. We had an 83.1%. Like, are you kidding me? Like, well, I can't ignore that. And you don't have to trade like me, but you can see that you are objectively having a 79.7%. This isn't subjective. This isn't me selling you a bridge saying, hey, trust me, bro, this order block is going to do X, Y, Z. I don't have to. I don't have to know what the market conditions are. I don't have to know what the high time frame trend was. Did you see me switch to any other time frame here to derive my idea that we're going here? No. Because I don't have to worry about that. I know that if I scale into my entries, right? Because remember, The equation that I always talk about. Profit equals statistical direction combined with how you manage risk. And then once you find both of those, combine that with a statistical profit target, SP. This is the equation that I came up with, and that is my guiding light to any model. Any model. For me personally, to execute on anything, I have to know my statistical direction. Boom. 79.7, 83.1. Combine that with how I manage my risk. I'm averaging into my trade. I'm being profitable, being wrong about the initial move because I'm a day trader trading on a small time frame. So I know that the fluctuations of price are going to be crazy. And I'm just going to average in with the tools that the market has given me, aka micros. Caveman trading. Exactly. Efi, if you held for that 83.1% hit, for sure you got margin call. Okay, Efi, we're gonna do a really cool experiment here because you said for sure, right? For sure, you're for sure that you would get margin call if you held to the 83.1. Who here agrees or disagrees? Who thinks that? Who thinks that if you held a trade right here, you would get margin called before coming here? Depends on the account size. Exactly. Exactly. It's all how you manage risk. You guys are looking at this. For those of you that see this drawdown right here, this is, you have to gauge your risk around the data. Guys, I'm not throwing minis on this. It's all how you size your positions. This is why I tell you it's not about the perfect entry. It's about how you manage your risk. And look at the equation here. Please listen to this, because if you said that, that tells me you're not paying attention. It's not just about getting to this direction. I'm not just shooting for a statistical direction. I'm combining a statistical direction with how I manage my risk and a statistical profit target. So again, with all due respect, you're not paying attention, because I'm not shooting for this entire move. I'm not shooting for this. I'm not trying to come here, catch this top, and ride it to 83.1%. I'm shooting for a statistical profit target, a small piece of this move, and I'm averaging in along the way. And if I lose, I lose. Cry me a river. It's in my how I manage my risk. If I do take a loss, it's within the math to do so. Right? So I'm shooting for a statistical direction, combining that with averaging in with micros, and shooting for a statistical profit target towards this direction. So that way, if we do fail to hit 83.1, guess what? I'm still out of the trade. I'm done. I got my small piece of the pie. That's why you guys see me even on midnight open, because let's use your same analogy. You said if you held for that 83.1% hit, for sure you got margin called, right? This is the problem with people's thinking in the trading industry. They think for sure, absolutely. They can't step outside of their own way of thinking. All these broken ways of thought, and just see if something is a little different. So even on days that I fail to retrace midnight, we still collect profit, baby. Why? Because I'm shooting for a statistical profit target. Because I'm not shooting for the entire move of midnight. I'm not, if midnight is here and price is up here, and I take a short, and then we just rip above midnight and we never even come back, I can still be profitable here. Because again, I'm not shooting for the entire move. So FA, does this make sense? Do you get this now? Do you understand? Because I don't want you guys to think that anything is off the table. I truly do. I love this. This is like what I'm super passionate about. I don't want anyone here thinking that there is any way black and white of trading. And the way that I trade is very, very different than most people, but it's something that I think is very doable for a lot of people. Like, you don't have to stress about the perfect entry. And exactly what Dr. J said, caveman trading. It's absolutely. Listen, I'm not trying to be the Michael Jordan of trading. If you guys came here to find out to get tops and bottoms, listen, I got many PDF courses to send your way that quote unquote find tops or bottoms. I don't know if they're successful. You can go be the judge of that. But you're probably here for a reason. I collect consistency, cash flow of the move, not taking a short right here to capture this whole move, because that's just unrealistic. I can't do that every day. I don't care who you are. You're going to get death by 1,000 paper cuts before collecting that move. If you position properly and scale only in profit, well, see, I would disagree with that, Mexican trader. You say if you position properly and scale only in profit, actually scaling in drawdown helps you more than scaling in profit. But we can talk about that in another workshop. Still shooting for 25 as you DCA into the market. 25 or what? It's not 25 points. Again, get out of the points mindset. Get out of the points mindset. Stop thinking in points. Stop thinking in ticks. Percentage. Okay, because you're going to go back test this shooting for 25 points, and it's going to be like 0.17% movement in 2022, but the percentage is always going to be the same, right? 0.12, 0.13% is always going to be 0.12 to 0.13% price movement. But why do I derive 0.12 to 0.13%? Because that's based on my entry. Again, you have to understand the context. You can't just start doing this shooting for 0.12 to 0.13. That is my statistical profit target. You may derive a way to get 0.17 high probability or even lower. It doesn't matter. But 0.12 to me is my unique statistical target. What if price 0.12 statistical profit immediately after entering the first DCA? Isn't that a small size winner? I'm just trying to learn your way. Exactly. Yeah, some base hits turn into home runs, ladies and gentlemen. Base hits turn into home runs. You are absolutely right. Good chunk of my trades, I would say 70-75% of my trades. I mean, we get into a midnight retracement trade and it'll carry maybe a little bit of drawdown and then go straight to profit. And then other times I get excited in drawdown. Why? Because I get to average into my trade. I get to unload the risk that's sitting on the sidelines for the minority of the time that I do take on drawdown. Like, let's say this, I'm not going to put my entry aids up here because I want you guys to understand the concept of this, not my specific way. I just want you to see the beauty in this, right? If I DCA, if I went short here, you'd be calling me an idiot right here. I'm shorting again. You'd be calling me an idiot here. I'm shorting again. Again, this is not martingale. I'm not martingaling. I'm using statistical profit targets combined with averaging in on objective entry criterias. And when I average into these, I'm not leaving my profit, let's say here, let's say it's 0.12. I'm not leaving my profit down here. If I average in here, boom, pulls my average up halfway because let's say I did 2 micros here, 2 micros here. That makes my average cost smack dab in the middle. So let's just have the midline being drawn. So right here, boom, that's my average. Let's say I get another one here. Okay, so this is now my average cost right here. Here's my new entry. Boom, pulls my entry up more. Now my entry is worth, or now my profit target is worth triple what it was worth down here, still giving the price plenty of room to breathe. My max loss is still plenty enough away from price, and I'm shooting for a statistical profit target. And if you were to take a risk to reward tool, because this is the biggest criticism people have with how I trade is, oh my God, dude, it's a negative risk to reward. Yep, you're right. But you also shouldn't win every single trade. And if you can't win every single trade and you can understand and agree that a 100% win rate is absolutely nonsense, then you can also agree that not every trade has to be perfect. You can't be either or, because we measure win rates in a collective amount of trades, right? You want to collect the win rate of a move out of the past 500 days, 500 sessions. You ain't going to tell me that your strategy is a 100% win rate and show me 2 trades. You're going to laugh. And so if a win rate is derived from a basket of trades, your risk to reward is derived from a basket of trades. You can't tell me that every single trade has to be like this, because then that's the same logic of every trade has to win. So my portfolio, my profit factor, my portfolio risk to reward is very positive, because majority of the time we go straight to profit, right? Or we kind of linger in and then go to profit. The minority of the time that my entry isn't the best, guess what? I'm averaging in. And so you could look at a black and white trade and say, oh my God, this guy's an idiot. Look at this. But then I average in here. Guess what? My stop loss, my max loss of that trade gets tighter. My entry gets here. My reward comes here. And then I average in again. My stop loss gets tighter. My average gets here. Blah, blah. You see what's happening? The risk to reward slowly, if I unloaded every single contract that I give myself, the risk to reward actually becomes very positive. It actually is like a 1.2 or something if you put all of the risk into a trade. And guess what? By this point, I'm either losing or winning. It is what it is. I'm still losing the same amount. The same amount that I would have to lose for this trade to come all the way down here is the same amount that this trade with more risk would have to come here. And so this risk to reward tool does not have to be your enemy of trying to make it the tightest thing ever, because it's just unrealistic to tell me that on a 1 minute time frame, 5 minute time frame, anything low, that I can consistently scale something doing this. I just you won't convince me that. You will not convince me that. Thank you, Austin, for this workshop. Now I finally understand your approach. Nice, absolutely, absolutely. And guys, I speak very directly and to the point. Please don't take offense to that or think I'm like talking abrasive or something. Guys, this is stuff that can really help you. This is stuff that is real, that I trade and practice every single day in front of people. And so if I do this right, I want you to get the most out of it. I don't want to sit here and go like sugarcoat it and be like, okay, now let's just slow down. No, like, dude, no, this is how it is. That's my way of showing love, is just being direct, stop wasting time, and just being real with me. Adding to a position moves your TP. Well, exactly, Scott. Exactly. If I add to a trade while I'm in profit, all that's doing for me, is it's destroying my average cost. So, like, let's just use this as an example, right? If I was here, okay, I still know that this 83.1% probability down here, this is my direction. Again, P equals statistical direction combined with how you manage risk, and then combine that with a statistical profit target. If I know that this is my statistical direction, and then let's say I do 3 micros, I don't know, I'm just as an example, right? And I want to dollar cost average into this. If I come down here, right, let's say I add to this trade right here. If I add to this, it has now pulled my now price only has to move 14 points for me to go into drawdown. Like, I have to now go, like, my original entry was up here, right? My original entry, price could do whatever the heck it wants to do, 31 points worth, just for me to start coming back to entry. Now, I added to this trade, I definitely have to be right. I absolutely have to be right here. Because if I'm not, I'm going to be wrong very fast. And now I've added more risk on the table. So now I can't let this trade breathe as much. I bottlenecked the trade because now, and again, I'm not saying that adding to a winning trade is bad. Somebody's going to hear this with 2 IQ points and say, he said adding to a winning trade is bad. No, I'm saying how I trade. The context of using statistics with managing a position for how I do it makes no sense, because now I have to be very, very right. And I don't care about being right about the initial move. I care about the statistics, right? And gauging my risk around the statistics. So if price comes back against me, right? Obviously, we know this trade ends up being profitable. But if this position now goes against me, like what if I add in again? Right? Now I just ruin my average even more. And eventually, if this comes back, I'm screwed. Right? I have to be very correct about this. So that's why I don't really like adding to winning positions or anything like that, because it just ruins my average entry. It ruins my average cost. And it doesn't do a net benefit to me, because it pulls my stop loss closer, it pulls my take profit further away, and it pulls my average cost further away, right? The only net benefit is I make more money, but guess what? If the net benefit that I'm chasing is to make more money, then why don't I make more money while also having other net benefits, like pulling my average closer to me, making my profit target closer so it has to perform less distance? That now I'm making more money, which is the same net benefit of adding to a positive trade, but now I'm getting the added benefit of a better average cost, right? A better stop loss position, a max loss position, and I'm getting more money for less price movement. So I'm getting more out of that relationship, more out of that exchange by adding to a drawdown than adding to a winning position. I noticed the last week or two, no upper footprints. Is that anything you factor into the setups? Nope. And I don't trade ES either raw. Why don't you code those lines into the indicator? It looks easy to do. Why don't you code those lines? Oh yeah, we got the Wolf hourly stats. It's a free indicator. If Wealth being on if Wealth being somebody wants to share the link, that's what this is. One of our members created this, and so going and cycling through the open hours, you can then, when you get that data point, put it right here, because this people keep seeing these and they think this is pulling the data. No, these are just lines that one of our members created, and you can put the text to say whatever you want. And so on each opening hour, I'm just cycling through the midnight snap and putting whatever the statistic says right here. Okay, so yeah, it's already made. If somebody wants to drop the link. Do you have a fixed number of DCAs you're going to enter the first position? Do you have a fixed number of DCAs you are going to do before entering the first position? Yeah, it's all derived based on, again, are we extended above? Because there's only two scenarios, right, that I'm managing my risk. It's either a high probability setup, which is my normal risk, or it's I'm foaming at the absolute freaking mouth because we are stupid overextended above or below the majority of the data. Okay, so if we start out opening here and we're overextended and every data point is below price, you best believe I'm going to add another micro to that to start the DCA process. If we're within the data, right, and let's just say there's some data points above, data points below, midnight's here and we're below midnight, I'm only looking for longs, and it's still a high probability long. I'm not filtering the trade. I'm not saying, nope, can't trade. Nope, can't do it. No, I'm a day trader. Okay. There's no honor in taking 2 trades a month. You're not a genius because you took 2 trades and I took 20. It doesn't matter. Are you using probabilities that align with how you trade? Okay. Trade frequency is only dependent on your model. There's no bad or worse trade frequency. I don't care what you say. There is no trade frequency that is a golden rule. It's just however you trade. And so for me, the high probability setup is still taking a position towards midnight. This is just how it is. So I'm just going to do my normal risk. It's a good question, Omar. And so that's why I tell you guys, it's up to you to do the homework that I told you guys. If you guys want to join, you got to do the homework. 500 back tests. paper trade this through the entire month. That's what you have to do and document every single portion of it. Is it hard? Does it involve you doing a little bit more work? Absolutely it does. Anything difficult is worth doing, right? And so that's how I gauge my risk, and that's the whole purpose of this workshop, is to show you guys using the midnight snap in various ways, and we're going to get to RTH here in a minute, how I gauge my risk around all of this different stuff. Can we discuss objective entry models? Footprint rejections. Easy. Nothing else. Nothing else. All right. This isn't the supermarket of entry models. We're not going to sit here and talk about 20,000 different ways to enter. Stop clouding your mind. Stop making it difficult on yourself. Objective entry model footprint rejections. That's it. Stop making it difficult. I gave you the answers to the test. Objective entry model footprint rejections. That's it. If you don't DCA, you don't DCA if in profit. Exactly. Nope. Never. Can work if you are sure price will retrace, but the question is when you stop. See, again, Mexican trader. Listen to what I'm saying, right? Listen to how you just structured that question. Thanks for explaining this DCA different strategy. Can work if you are sure price will retrace. You best believe I'm for sure price is going to retrace because we have 79.7% of going here, 86.2. I don't have to have a for sure feeling, right? I'm not in any of this. I don't have a feeling. There's no feeling here. It's objective black and white data. So I know that 80% of the time we're going to go here. And if I'm wrong, I'm shooting for a statistical profit target, so I'm capturing portion of the move. And if my statistical profit target fails, I'm DCAing. And if DCAing fails, guess what? Price doesn't move in a straight line. Okay, so price doesn't just do this. Even in a heavy uptrend, it's going to correct at some point. And either I'm hitting a profit in that correction or I'm losing the trade. And I'm losing the trade derived from a max loss, a max budget, not a max loss as in I blow an account in a single trade, a max loss that I create for myself based on my risk parameters, based on how much risk I'm using per trade. I'm using that based on and how do I derive that? It's all in doing the work. That is what people misunderstand and do not hear when I say this, and that's why I repeat it so much. And a lot of people are like, Austin, why do you repeat yourself? Because I have to. You have to do the work. All of this starts from you being a little uncomfortable, spending about a month of just being very intimate and understanding and studying one asset, studying one move, building data around every portion of it, your statistical profit target, how many contracts could you do to average in, and guess what? That homework does all of this. That homework that I gave you guys answers and goes over all of this. So there is no, I am for sure price is going to go here. I don't know what price is going to do. Guys, we have 80% probability still getting failed some days. Why? Because it's not 100. If I have an 80% probability here and I take a short here and we just fail it, does that mean that this is bad? No. This data is 80% for a reason. This is 80% out of the past 900 plus days. So a good portion of 900 plus days. What's 80% of 950? Let's see. 950, multiply that by 0.80. That's 760. 760. So 850 minus 760, that means 90. 90 days out of that 850. It's a good chunk of days, right? You try trading for 90 days straight and tell me 90 isn't small or big. That's a lot of days. So you best believe there's going to be days that still fail to retrace in 80%. That doesn't mean this is broken. That means you have to gauge your risk accordingly to when this doesn't happen. That's why I have what I have here. Statistical direction is just one part of the move. Then I'm averaging in. So if this is 80% and I average, let's say I short the absolute bottom. Oh my God, I shorted the absolute bottom. And then we short here. So then we short here again when we start correcting. And now my average cost is, let's use this red line here. Oh, I take into some more drawdown. Well, good thing I'm using micros and not minis, so I can afford this drawdown. So let's say I take another short here. Now my average entry gets pulled up to here. Let's say I just lose, right? Well, now I just lost the trade because with a statistical movement, how much I derived from all the data that I built, how much I am willing to lose in this trade. Just like how if you were to single entry trade, if you were taking trades based on a single tight stop loss, well, you still have to have an endpoint. You're not going to use a tight stop loss and just keep on losing until infinity, right? And blow that account that day. You still have a dollar figure attached to that max loss that you're going to give yourself per day. And so if you try to catch tops and bottoms and you get paper cutted 10 times and you lost $200 per account or $100 per trade, that's $1,000. And I'm pretty sure many people, that's a reality, right? You're down 800, 900, $1,000 because you're trying to catch those tops and bottoms. Well, guess what? I take that $1,000 and instead of having all of these paper cuts, I just condense it into average positions. And then if I am completely wrong, if this data, if this 80% down here fails above everything else, I take $1,000 loss. I would do that anyways if I was trying to do this. Right? I would have already lost, I would have been down $1,000 if I did this and this and this and this. So it doesn't matter. I'm still gauging my risk around the statistical direction, shooting for a statistical profit target. Does that make sense? The percentage you shoot for while in the trade be different for each trade, or they're just a risk tolerance for your account that you should set. JR Hood, it's a statistical profit target, okay? So the statistical profit target is always going to be what the data tells me. And you're not going to have a statistical profit target unless you do the data. And you're not going to have the data unless you build the data yourself and back test it and test it and test it again and test it a seventh time. There you go. Wealth Bing, thank you. I'm guessing when it hits max daily loss limit. No, that is. I think you're behind on the chat, so I hope that you would know now that I do not use a max daily loss limit as my stop loss. But there you go. Yeah. Are you DCAing the midnight setup only, or do you also DCA the range trades for 10 points? Yes, I do, but it's a little different because I'm using minis on those and not micros. So the DCAs are only going to be like 2, maybe 3, but I'm still going to have the set amount of loss. 6 to 8 a.m. opens, which have higher probabilities, because it's usually the most extended. That's a really good question, because if you notice, the midnight is the ultimate direction, because these 6 to 8 a.m. open prices, they just let us know our left and right limits. They let us know where we're at in the environment. Now, again, do you have to use midnight? No, you don't have to. You truly don't. I like midnight because by 8 a.m., we're usually overextended in a single direction. Now, sometimes, obviously, sometimes we'll literally open up and cross midnight in 2 seconds, but a good chunk of the times, it's what this looks like, right? Where we're overextended above or below midnight, and we make that nice movement towards or above or below midnight. So that's why, is because from midnight to 8, that's 8 hours of time that price can extend away. And so if I know that when price extends away from 8 hours ago and I can still have a 65 to 68% accuracy, that is crazy good. And now I just take that and make it even better by using how I structure my risk and my statistical profit targets. And now I take that 65 to 68 and I go even higher in terms of accuracy, because I'm using the risk to tailor when I'm either having a high probability setup or I'm foaming at the mouth. I sworn you said you're having a heart attack. Thank you, Austin. It's probably the best workshop I've ever attended. You speak. Thank you. Okay. Awesome. 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 See, I'm just really passionate about this, man. I could talk about this for hours. So if it sounds like I'm having a heart attack, it's just because I love it. I love it, and I want you guys to really, really understand what I mean. Because a lot of people they'll come in here, right? And they'll just, so this is Martingale. Oh, just leave. I want people that are able to three dimensionally and critically think. Okay, I don't want people that's like, so where's your stop loss? Exactly what perpetual LR is saying is exactly what I'm saying not to say. So everybody say goodbye to perpetual LR. They will be banned after today. Host trader, I had sent you the point in the back 10 sessions. Please start. You get host trader. I'm gonna take host trader's message and I'm gonna frame it. It's gonna be in the most expensive frame I can find at Walmart, and it's going to be on my bedside table, and I'm going to look at it every single day with a smile on my face that somebody understands what I mean. That is exactly correct, ladies and gentlemen. If you're listening to the recording, the questions that a lot of people ask, that's why I tell people I don't say it to sound mean or to be aggressive or to be lazy and not answer your question. The reason why I say if you're asking where my stop loss is, if you're asking how many contracts am I using or XYZ, it's because you haven't really understood what I'm doing. And I'm not going to do you a disservice and spoon feed you those questions, because then guess what? You ask me how many contracts am I using? The next question is, when are you averaging next? And then the next question is, how did you determine that average? And the next question is, well, where's your loss now? It's going to cascade into other questions that if you take the time, go through the Google Sheets, it's all free, it's all there for free. Then you're going to start to see that those questions are going to be answered through just practicing this, back testing this, seeing this for yourself. I have all the answers laid out for you. You just have to go put in the work. And the ultimate filter, ladies and gentlemen, is I just want to see who wants to put in the work and who's lazy. That's it. That's it. Like, I just want to see who is actually going to sit here and do a little bit of monotonous work, because 500 trades, 500 backtest trades, and then paper trading it's pretty monotonous, but it's useful, and you start to burn it into the back of your brain. So Omar, for example, the 50K top step funded account with a 2,000 max drawdown, let's say a max of 500 daily loss, basically giving myself 4 consecutive losing days. What do you assess for the DCA size increment? Omar, I'm going to tell you exactly what I just said. Go do it for yourself and you tell me. I am not giving you a blanket DCA size, right? There is so many factors to that question that has to be answered that I want you to go find for yourself, because that's how you're going to know. Because then you're going to say, well, how to do this and how to do that. You have to go do this yourself. I'm giving you the foundation. Now you have to go and learn. You have to go and find what that max daily loss is for you. I can't do it. It's not going to be black and white. This isn't something that's just as simple as you're going to know in a matter of 10 minutes. I'm giving you the foundation, and then you have to go and do this yourself. Could you show us one example session to fulfill the assignment? Yeah, it's in the spreadsheet, FA. In the spreadsheet, I show an example and everything. I have all the examples there. Where's your stop loss? All right. So now let's go over the last one, okay? So the recording is an hour and 9 minutes. So I'm a little over time, but it's all right. It's all right. You guys had some really good questions, and we talked about a lot of good stuff. So the last one, okay? So I'm going to use Friday as an example because Fridays and Mondays for NASDAQ is stupid good for RTH gaps. So let's start back at right before 9:30 market open. So right here, okay? So what you can do with the midnight snap in terms of RTH, again, we're not trading the RTH gap. We're using the RTH gap to show us where the statistical direction is highest, right? Like you already know that in this specific Friday, we had look at this. We had every opening hour probability retracement, right? We had everything. So how else can you see where your statistical direction is when all these other points have been hit? Boom. Let's go to RTH, regular trading hours. Again, please make sure. I've already had like 4 people being like, dude, the RTH gap data isn't working. Are you on RTH? Is it plugged in? And they're like, oh, okay. So make sure you're on RTH. Okay, it's on the bottom right of your chart. RTH, electronic, and regular. Make sure you're on regular because you can't have an RTH gap if you're not on RTH, right? So when you're on RTH, you're then going to come over here and click Show Gap Statistics. Show Gap Statistics. And now here's a super cool thing you can do. So before every market open, there's going to naturally be a gap most days. Some days we come and we open right where we close at settlement, but most days we create a gap. And so you can take the midnight snap and just slowly in increments increase this gap data until you see what a 100% probability in the past 9 Fridays are. And again, people will be like, well, you use 900 plus days on midnight. Why are you only using 9 Fridays or 44 days in total to do this? Because this is a variable data point. Okay, gaps are going to be different sizes every single day. Midnight is always going to be midnight, right? You go and look up midnight in 2010, midnight was still 0000 with no point differences or anything like that. These gap sizes, some days they're going to be 23.25 points, 41.75. They're going to be different sizes every day. And guess what? These different sizes are derived from the market conditions. And the market conditions, you want to see what current market conditions are. Okay, and so 9 Fridays is really good to see, okay, 9 Fridays, that's a pretty good idea of what current market conditions are. That's what? It's like 2 months. That's 2 months of current market. The market conditions change monthly, bro. So knowing what the past 9 Fridays is, that's really good. And so you can cycle through this. I don't know why it's not showing 100 because it definitely is 100 at 38%. I think it's because I'm in, what is this? I'm in Friday. Can I go here? Is that ruining the statistic? Let's see. Well, it's 100% on Monday, but I don't know why it's not showing Friday. Let's just do 30, whatever the 100% is. Dude, these indicators always like to make me look stupid when when I'm streaming or live streaming in front of people or recording. All right, so it's still saying, I'm not sure why, because 38% is definitely 100%. We've been shooting for that for a while now. That's weird. I don't know why it's saying that. Either way, 38% was 100. 38% was absolutely 100. I just don't know why it's not showing you. There may be a day worth dragging it down. I don't know. But it was 38%. And so what this is showing you is when the market opens. Okay, so let's now fast forward to market open in replay mode. Why is this not working? Dude. What are you doing, man? You guys see what's happening right now? What is this? What is going on? $16.59. Why is this not going in replay mode? Do I have to wait for market open? That is so weird. Okay, so let's just act like market open because I don't know what the heck trading views on right now. All right, RTH. We're 1 minute into market open. What the heck is going on? Replay mode. We'll do 9:36. RTH. Dude. Okay, we're going to go to a different day. I don't know why it's freaking out like that. We'll do this Friday. Yeah, the market makers are sabotaging me. I don't know what's going on. It keeps glitching when I try to go forward. It won't. It just goes back to current time. Okay, so right here. Okay, so we're on the 1 minute candle. So as soon as market opens, now this will happen when you guys are watching this live, and that's why I tell people, like especially when I'm live in front of people, hey, watch me real quick because sometimes this is quick. So if we know that 38% has a 100% probability, and if I go back here, you'll see it's up to, you see how it says 100%? It's because when you're on that current day, it's now taking into account that current day, and so it'll drag that probability down. But right now, going into this session, we have a 100% probability of retracing 38% worth. Now you can just slowly increment this up, and you see how it dropped off? It's not 100%. So now you know 38% in the past 7 Fridays, and then obviously the data isn't producing, but it would be in this current day 9. You would still be looking at the previous 9, and it would still say 100. And so you know 38% of that gap is going to be retraced 100% of the past 7. Now, does that mean it has to do that? No. But you have a 100% probability. And so now, market opens, midnight snap will draw the gap. And you see this dotted line right here? This dotted line represents exactly the percentage to the 1 to 38. This is exactly 38% of this gap. Okay, watch this. If I put 50, that dotted line is going to move, and I'm going to make it white so you can see it. It's going to move 50. If I wanted to see 79%, it's going to move 79% of this gap right there. If I wanted to see 3%, obviously 3% is going to be stupid high because that's basically tapping it, but watch what happens. The box is going to go away because it successfully retraced 3% of it. See how it went away? So now you're getting a bunch of 100% probabilities because it's 3% of the gap. And so now let's go back to 38. And so as market's opening, you can take the RTH tool, or you can take this line tool on the RTH gap, trace over the 100% probability, 100%, and just add a little note here. Now go back to ETH, the regular chart that you are normally using to trade with, and have the replay mode screw up so that way when you're recording this, it makes you look stupid. Oh man, what Friday were we at? Was it this Friday? Dude, TradingView seriously sucks sometimes. Ah, here it is. Okay, right here. Okay, so market open, 9:30, right there. All right, so this was the line that we drew. Okay, if I drag this out, this line right here has a 100% probability attached to it. Now, you add this 100% probability, look at everything else we have. Right? We retraced 5, 4, 8, 6, and 7. We have 100% probability we're coming here. We have 3 o'clock here, 1 o'clock here, 2 o'clock, midnight all the way down here. You best believe I'm only looking for shorts. I don't care. Look at this. I don't care how bullish we look. Oh my, because people that are like, I trade straight price action, bro. What does that even mean? Straight price action. What does that mean? But either way, look at this. Look how bullish we are. We made a little bit of a low. Made a little bit low. We came back. Right? We came back. We're making structure to the upside. So you're bullish. High time frame order flow, bullish. You don't know what order flow is. But anyways, so you're saying this is bullish, but look at this. Like everything is below price. So we may be bullish long term, or at least in the longer than 5 hours, 6 hours. But I'm a day trader. I'm in and out of a trade in 40, 50 minutes, hour, maybe on average. So I don't care what we're doing 7 hours from now. I care what we're doing now because I'm a day trader. So now we know that everything is below price. Let's see what price does. We pump up, everybody's long, boom. Everybody's long right here. Everyone was getting in longs here. Everyone was getting in longs here. Slapped you in the face. 100% probability retraced. 71.7% probability retraced. 70% probability retraced. 68.9% retraced. Midnight on a dime gets retraced. Every single data point has now been retraced. And this entire move, when we were all the way up here, 100 plus points of opportunity. And guess what I only shoot for? I only shoot for 25 to 10, whatever, and I get 45, 55, 65 points. I'm good on that day. Pretty crazy, right? So you can use that RTH not to just directly trade to it, right? Or trade using it. You're using it to give you your statistical directions to gauge your risk off of, to tailor that risk, right? So does anybody have any questions on that? It's pretty straightforward. RTH is RTH, right? There's no there's no crazy mystical things about that. Yes, this is being recorded. Non-binary price action. All right, guys, I'm going to pause the recording and then I'll just get some more audience questions and discussion. So if you guys are watching the recording, thank you for watching. I hope this was helpful for you, and I will see you next time.